Good evening, everybody. Thank you very much for joining in today's Wealth Growth Club. We are just in the process of going live now. I think it takes perhaps 30, 40 seconds just to roll out over YouTube, Facebook, LinkedIn, and the other social media platforms. So I'll just give everyone just a few seconds to join. But today's main topic of conversation is really around what types of properties make good investments and how to acquire them. Okay, and that's really what we're going to focus on today. And if you've got any questions, do type them into the chat, and I will do my best to try and answer them online, as it were. I can't guarantee to see every question, because obviously what happens here, we've got like an aggregated feed. So any feedback that comes in via YouTube, Facebook, or LinkedIn, I should be able to see, and I'll try and actually answer that in real time for you. So sort of move on a little bit now onto the main part of it today. Now, Tracy's not with me today. She's going to be joining us next week. And these are the points that we plan to cover today. So basically, we're going to be discussing the whole aspect around normal single occupancy type rentals. Also, we'll be looking at houses of multiple occupancy, what are known as HMOs in the trade, as it were. How serviced accommodation can have its uses as well, and how you may choose partnerships as a good way of actually growing your portfolio. Sometimes it's worth spreading the risk or the love around, as it were, to seek new opportunities. And if you yourself don't want to invest in properties, but actually love working with property, there's something called property sourcing. So these are the main points that we'll be discussing. So with that in mind, let's just talk a little bit about single occupancy now. And that is what you regard as someone, for example, a landlord acquiring a property may choose, will want to work out the yield he or she is going to make as a return on the property, and what type of money will actually receive back. Now, obviously, in the UK, generally things got a bit more difficult in this space, because a previous administration, the government, as it were, decided to do away, for example, with the ability to be able to offset your mortgage interest as tax relief against your costs. So effectively, that makes it more difficult for single property owners as landlords. It doesn't mean to say it's not viable. It is still viable to do it, but you just have to make sure all the numbers actually stack up. And the other thing as well is really this whole aspect around over what changes are going to occur due to what we've got coming with the new administration. Now, obviously, the Labour government has made certain types of undertakings and promises, so hopefully not too much. But the other point of discussion around single occupancy is the fact that is the whole aspect around no fault lease agreements, and whether they're right and just, everything else that goes with it. Now, that obviously does pose a further risk to landlords, which need to be thought about. But if you can find a property which you can rent out, and let's say you are able to raise 25% as a deposit, obviously you can finance the other 75%. Mortgage rates, if anything, are going down a little bit now, so hopefully that'll make things a bit easier. It's then making sure you look at the yield properly on those properties to make sure the numbers stack up. And crucially, if either rates go up quite a bit, or if you have a void period on that property, can you actually sustain it? Can you still pay the mortgage interest without getting yourself into difficulties? Now, obviously, we're not going to be debating it today, but clearly there is a debate to be had as to whether you should actually own the property in your own right, or whether that should actually be in a limited company. And that's something which you need advice from a tax specialist. And of course, especially if you've got a portfolio of properties, then it becomes increasingly important. Okay, so the other thing which we'll move on to next a little bit, really, and this is where the real opportunities can rest, is if you can find a property which is ideal for as a house of multiple occupancy. Now, what do I mean by that? Well, that's about finding a property, for example, which allows you to rent out the rooms to more than one tenant. So you might have found, for example, a 4-bedroom property. If you get 4 individual lets, then of course the yield or the returns you can get on that can be considerably higher. Okay, much higher. And then the other thing to factor in is that you may get one tenant leave under normal circumstances, unless you're in an area which, say, a university town, it's unusual for all tenants to leave at the same time. So your risks can go down with house of multiple occupancy. But obviously you need to do a lot of research to make sure that you're investing in property in the right towns. So whether it's not a saturation of HMOs, if so, you might have a trouble getting the right type of yield, or you may find you can only occupy 2 rooms out of the 4, and that can be a real challenge. Okay, now obviously university towns, good thing with that is that typically in advance, have a good idea of who might be leaving at the end of a year, and then equally you typically have people in advance stipulating that they'd be interested in the rental. So house multiple occupancy could be very good investments. Student accommodation, that's the more typical one. The other thing you need to consider around that is this whole thing around whether you need to obtain a license. And there are certain areas where if you have 5 rooms or more, in fact, many areas where you actually need a license from the local authority to actually be able to operate in that format. Now, does that need to delay you rolling that out? No, I believe that you can still do it. And basically get tenants while you're waiting for the license to be approved. But obviously there is an element of risk there, so it's generally better to do it the other way around if you can. So that's another consideration. And for example, you've got to think about, if it is going to be a house of multiple occupancy, are you going to have a living room which everyone can share? Are you going to have combined kitchen dining area as well? What are you going to do about bathrooms, for example? And all these will impact basically how many rooms you can actually let out, both in terms of what's practical, but also what's likely to be approved by the local authority should it need to be licensed. So, for example, it can pay sometimes to turn the bedroom more into a little kitchenette as well. Obviously, you've got to factor in any fire risks into that equation as well. But obviously that can create extra flexibility. And then the other part around that is whether you should be looking at something like Airbnb or Booking.com as a way of getting a return on your investment. So that wouldn't necessarily be an HMO, but that is a different way of attracting revenue, and potentially you can get much higher returns from that. But the other side of it is that you have a lot more in the way of administration. And the other option, of course, is serviced accommodation. So it could be that you want to find long-term lets, but it's very, very high caliber accommodation, which is already furnished, and you might be appealing to working professionals in that scenario. And obviously these can make a really big difference to the amount of monthly revenues that you achieve, but also to asset growth. For example, if a property that has got a history of being suitable as an HMO, and you've got very high occupancy rates, then you tend to find that rather than being treated as more as a residential valuation, is perhaps treated more as a commercial valuation. So those are good considerations. Now, with HMOs or something similar, you need to factor in room size requirements, because there are certain requirements for a room to be of above a certain size to actually be lettable. Also, you need to factor in amenities and safety standards, and you may need to consider things like fire safety. doors, alarm systems, emergency lighting. And also you might need to look at things like pest control and what maintenance records you actually maintain around that. So just in summary of that, you've got licensed, unlicensed, Article 4 HMOs. That means those are in areas where you have to get an Article 4 license. And you can easily check that online by checking against the individual local authority websites regarding their policies. And the other part around funding properties for investment, for sort of not commercial properties as in for office use, but where you want to use it to generate income, is what type of mortgage or finance are you looking for? Are you looking for a mortgage which is repayment only, or repayment, i.e. where the interest and the capital is repaid, or are you looking for interest only? Or alternatively, another way of acquiring a property, not that you own, but is more of a rent to rent. So it might be you find a landlord, for example, who gets rather fed up because they tend to have low occupancy, but you believe you can do a lot better by making improvements to the property in some shape or form. And you can do what's classed as rent to rent. So you might be, for example, find a property which is you give perhaps £1,500 a month to the landlord, but you believe by renting it out yourself, you can get over, say, £2,000 a month in rental income. And that would obviously generate you £500 a month profit. Now, you might say to yourself, why would you do that? Because you're missing out on all the potential capital growth. One of the big things is it's incredibly simple to set up. So, for example, you don't have to go to a finance company to raise a mortgage. Okay, and so it's easy to get going very quickly with that. And it might be you can agree a rental, which might be, you'd say, well, look, I'm interested in renting it from you for 5 years, but I want a break clause after 12 months. So you can actually validate that it's going to give you a return on your monies before you lock yourself in. Typically, if you're going to do that, you probably need to spend some money on refurbishment. So you may want some money, may need some form of undertaking from the landlord that they're going to agree for a longer term let with the option of a break clause, so you can afford to invest in the property to make improvements, to make it more suitable for renting out. And the other thing around that is you could look at rent to buy. Now, what that basically means is that instead of going to a bank to borrow money, you actually come to a deal where you pay an extra amount each month, and that actually is a certain amount is used to actually acquire equity in the property. And that does pose a little bit of a risk to you and to the landlord, especially if you find you can't stay there for the full term that you've actually agreed. Or on the other hand, it does mean that your creditworthiness, etc., doesn't really come into play to the same extent, and it can enable you to expand your portfolio a lot more quickly. The other thing which can be relevant is of shared ownership. Now, that's a bit of a different arrangement, and I don't think we'll probably discuss that today, but certainly from a purchase point of view, that is a bit of an opportunity. It can be a really good way to help people get on the housing ladder. And then the other alternative you've got around that is renting a property, but with a lease option. So they're typically known as lease options in the trade. So there you may agree a rental for 5 or 10 years, and it may be that, but you agree today, for example, what price you're prepared to pay for the property 5 or 10 years, as an example. It could be 7 years, of which then you basically give the landlord that payment, and then the equity in the property, actually the property then ownership transfers to you. Now, it is basically a lease option rather than a lease obligation. So what I mean by that is that if, for example, the market took a turn the other way and prices dropped, you wouldn't be legally obligated to buy the property. In real terms, you'll find that most people who are considering a lease option arrangement actually go in with the is in mind with a view to still acquire the asset in 3, 5, 7, 10 years time. Okay, and that is important because obviously you may want to make a lot of improvements so you can actually rent the property out to the right tenants. And then let's look at another aspect of this. This is again more looking at HMOs again. For example, are you going to offer like an all-inclusive model where all the bills are included within the rent? The problem is there, for example, if the tenants don't care particularly about the energy bills that you're running up, then of course you can end up with much bigger energy bills than you would otherwise like. You could go for non-exclusive arrangements where tenants pay their own bills, but that has got its own problems because they can leave with unpaid debt. Or you can offer something which is partially inclusive. And that's also a very, very popular option. Okay, so then moving on a little bit from that, we talked a little bit earlier on about how properties can be valued as a bricks and mortar valuation, i.e. the physical property value, or whether a property is valued on a commercial basis, taking into account the rental income the property generates. So, for example, let's take a case in point. Let's say where it took an HMO and you converted the property so the rooms had kitchenettes, and rather than having central heating, it may be that you actually put in storage heaters into each room. Then typically the yield you may get on the property would be very good, but also there's very little in the way of costs, and potentially you can ask the go to your bank or maybe more to a commercial lender, and they may give you a higher loan to value ratio, which enables you then to release the other 20-25% equity in the property, which you can then use to acquire more property investments. So anything you can do to increase your income yields and asset values can make a massive difference as far as all of this is concerned. So we talked about that. Now, the next part I promised to talk about was a little bit around serviced accommodation. And this is more looking at Airbnb and Booking.com as a case in point. So effectively, the way you tend to look at that is rather than being a monthly rental, which might be for 12 months agreement, it might be that you actually rent the property out on a nightly basis. Okay. For example, as you're going on holiday, you book for a conference or an experience or choosing accommodation. And then in that scenario, you're talking about short-term occupancy rather than long-term occupancy. The legislation currently is a lot less intensive as far as that is concerned. Now that is changing a bit, and certain other countries become very hostile to Airbnb, for example, as a case in point. So it can be a lot less restrictive, but obviously the world is moving, all the time. So Booking.com and Airbnb are the ones that immediately jump out at you there. Obviously, if you're looking at serviced accommodation, the property presentation is really important. You need to make sure the property is pretty well of immaculate condition. And I deliberately use that word because basically having a 5-star review is actually really important. So ratings, reviews, and photos are big deciding factors of people wanting to come in as guests. And you need to be very proactive with guests. You can't be passive like you might be as a normal landlord. And for example, the reason why a 5-star review is particularly important is that everyone knows that people always don't like giving bad reviews. So something that is a bit indifferent might be rated as a 4-star or even a 3-star, but people will always gravitate more for the ones with the 5-star reviews first. And therefore, as well, it's important to make sure you're very efficient in your operation. So systemization, for example, and using technology to streamline the whole process of your bookings is important. And don't try and cut corners with this. It's really important that you actually use professional photography on your property, and that you don't try and cut corners in that regard. Um, so uh, so do that, and that way you can make sure that everything is working pretty well for you. And it's also important to understand the timing a time that's required for uplisting those rentals, and therefore your guest booking system needs to be kept up to date. You may want to consider using key boxes and digital keypads for guests. Use automated messaging for helping for check-ins, check-outs. Understanding the costs, i.e. the nightly rate, the occupancy, the cost of utilities, management fees. Factor in whether to buy linen in or to hire it out, or to look at guest management. For example, having a dedicated phone number rather than your main phone number, because you could get very irritated by the calls. And use WhatsApp to maximum advantage. It really can be a big time saver, as well as arranging for good communication with your tenants. And then the other part, sort of leading on from that, really is about security. Now, obviously, you can use cameras, but use cameras responsibly to monitor guest numbers and behaviour. So, for example, you might find someone rents out an Airbnb for 4 people, but you suddenly find there's actually 8 people sharing that rental, or perhaps even more, or they perhaps want to rent it out with a view to using it for parties and things like that. Now, sometimes you can get certain devices which monitor for noise rather than, and that can be less intrusive than using cameras. So, for example, noise nuisance can be a big issue with something like Airbnb, and having something which tracks the overall general noise that's being generated from the property and sending alerts to you if you feel it's getting out of hand, then that gives you a little bit of extra contingency around that. And it's also making sure you understand the numbers. So having a good cash flow calculator, so you can compare the serviced accommodation versus a single let. And then you've got occupancy rates and their understanding their impact on income, doing some clear break-even analysis and setting the rates, and looking at your additional costs like cleaning, linen, platform fees, etc. So, for example, in the summertime, you may have no trouble, finding getting bookings for your accommodation. But it may be that at Christmas, not Christmas time, but certain other times of the year, it's very, very quiet. So if your occupancy is like 60% or 70%, it might seem good to you, but in real terms, that may be wholly inadequate. So those some of the main points we covered. The other part I did want to talk about a little bit is around the whole area around partnerships. And just going to try and bring up my stream again, so the screen properly, so I can see what's going on here. And with partnerships, for example, you may have found a property that you particularly like, or maybe building up a portfolio property. Quite often, if you can do things in partnership with other investors, that's a great way of spreading your risk, but also creating even more opportunity. So do look at partnerships as another way of getting involved. And then finally, really, the other part too is really to do with property sourcing. So it might be where you actually don't want to invest yourself, or you may have got a small portfolio of properties, but actually what you'd like to do is be able to introduce tenants to landlords. So you're acting a bit like an estate agent, but you're acting more as an introducer to the landlords there, okay? And that can create another revenue stream for you. Now, the important thing to understand on that is that you would actually have to register effectively as an estate agent, as a deal sourcer. And that is rather bound with compliance, is rather changed from how it was a few years ago. So, for example, you need to register with the Property Ombudsman Scheme or very similar. You also need to register with HMRC because you would also have to take people through HML or money laundering regulations, which is a pain in the whatsits, to be perfectly frank. You might need indemnity insurance, which is very cheap. Actually, you probably can get that for £150 a year. And you may also you will need to register for the data protection register. Now, that's very straightforward. So even as a deal sourcer, you are, in the eyes of the law, treated as an estate agent. It's almost like the opposite way around, but it is regarded as the same. And therefore, you need to make sure legally compliant. Otherwise, people won't take you seriously. Now, we're almost at the end of today, but if you've got any questions, do ask them in the chat. And if I'm still on line, I'll try and answer those for you now. If not, I'll get back to you as soon as I can. So I'll just show my screen again just for a second. Bear me a minute. Do this the correct way. Right, there we go. So that's what we've been discussing today. Sort of moving on really in terms of next week, what we're going to be looking at things rather the other way around. So we're going to be looking at it more about, if you're thinking of buying a property, should you consider using a buyer representation agent? Okay. And it's a big thing, actually. It's interesting. In the US, it's very popular. And in many European countries, in the UK, it's not so well known, but there can be lots of cases where people might want to use a buyer representation agent. So it may be, for example, someone who's very time challenged or time poor. It might be someone who's very nervous about the property market and doesn't know who to trust. It may be that they want someone to help them undertake review and research certain areas. And rather than representing the seller, perhaps in that scenario, you're representing the buyer. And we'll be discussing that in depth next week. In terms of if you want to reach out to me, by all means, just save that number to your phone. It's 07912 600 999, or just send me a WhatsApp message or text me. And those are my email addresses that you can see there. And we run the Wealth Growth Club every week. You're very welcome to take part in that. That's at 7 o'clock. That's UK time. And those are the handles to be able to gain access to today. So I just I can't see any questions being added here, but we do find that people ask them later on. So when this finishes, it will automatically save as a recording on YouTube, Facebook, LinkedIn, etc. And do feel free to come back to it. And hopefully, I'll see you next week. But thank you very much for joining this evening. Really appreciate it, and hopefully you found some value today. So thank you very much indeed. Take care. Bye bye.